Good evening and a warm welcome to everyone. Thank you for joining us this evening at the FSM Choice Awards 2020. This year's event represents a milestone for us as we celebrate 20 years of helping you and all our investors invest globally and profitably. And for that, we would like to express our thanks and gratitude to all our clients for your support. My name is Jonathan and I'm your MC for this evening. Tonight, in continuing with our mission of helping investors to invest globally and profitably, we will put the spotlight on 11 outstanding unit trusts and one fund manager. These unit trusts are FSM investors' top choice of funds or have been carefully selected by our in-house research and analysis team based on quantitative methodologies that place emphasis on the consistency of their performance and ability to manage risk. With more than 1,500 unit trusts available on fsm1.com from more than 150 fund managers, emerging on top is certainly an impressive feat. In addition to announcing our Choice Awards winners, we are also launching the 2020 and 2021 edition of our recommended funds. We hope both the FSM Choice Awards and our updated list of recommended funds will serve to give you a head start in seeking out the best investment opportunities to navigate the tough market conditions that we find ourselves in this year. So without further ado, I'd like to kick off tonight, and I would like to invite Mr. Jean-Paul Wong, General Manager of FSM1.com, to give us the opening speech. Mr. Jean-Paul, please.
Thank you, Jonathan. And good evening, ladies and gentlemen. On behalf of the team here at FSM1, it is my pleasure to welcome you to FSM Choice Awards 2020. I would like to thank our investors for taking the time to join us tonight, and I hope that you're all staying safe and healthy. I would also like to take the chance to thank our fund house partners, many of whom have been with us on the fund's journey for many years, and you'll be hearing a few of them later during our panel discussion and in the Choice Awards videos. "20 years ago, McDonald's had a Hello Kitty promotion, and that led to much exuberance, long queues, and some say catfights. It was also the year when the Nokia 3310 sold like hotcakes worldwide. While this likely did not hawk international headlines in the year 2000, an online funds supermarket started business for investors in Singapore, offering a small pool of unit trusts from a few fund houses. The company also launched a magazine, which we call Recommended Funds Report, the following year in the year 2001. The magazine's name back then was Fundsupermart. Today, even though the online fund supermarket has since grown to become FSM1, an online platform offering multiple products and services for investors to grow their wealth, we have kept the Fundsupermart name for the Recommended Funds Report because the name is synonymous with funds, firstly, but also because it encapsulates a few ideas that we believe remain true till today for investors. One of that idea is how do we achieve our mission statement of helping investors invest globally and profitably as seamlessly as possible. Please allow me to share with you some of the tools and resources that will be like the guideposts, giving you clues in your investment journey. I'll start off here with some of the tools, with a couple of tools. So first here on this slide, you'll see the fund selector, perennial favorite with a lot of investors when it comes to unit trust, selections and comparisons. So for example, if you want to zoom in on certain favorite ideas, for example, dividends, or if you're looking at the Singapore market, for example, you can actually make use of this fund selector tool to narrow into some of the funds that qualify based on the criteria that you've chosen. If you're someone who prefer visual comparisons on a chart, if you want to look at a fund versus the index, or you can actually make use of fund comparison as well on this chart across different time periods, you can make use of this tool that we call the Chart Center. Another resource that I'd like to share with you today, it's the CPF Investment educational website that we have created at the start of this year. On this website, you'll find a few tools. So one of them on this slide you'll see is the Dynamic Portfolio Builder, which shows you the different asset allocation across the main regions of the world. You can see how much you need for a lump sum investment, for example, to build a globally diversified portfolio. Likewise, you can also see how that works out if you want to do a regular savings plan or what we call an RSP. Another point I would like to share with you, it's our research emphasis on building a globally diversified portfolio, and of course, the concept of diversification and asset allocation. So the ability to have an easy access to global markets and different investment strategies without exposing ourselves to too much risk into one asset class, I think that's one thing that unit trusts have been able to do for us and for myself, for my portfolio, all these years. So in many ways, we like to liken or compare that concept in terms of how you manage a football team based on three key principles. So first, make sure that you have a core portfolio built on the back of core regions, and keep your more exciting and possibly, usually those are the more volatile ideas, within the smaller supplementary or what we call the tactical portion of your portfolio. So, if you're looking at some numbers, 80% in the core and 20% in the supplementary could be one way to look at it. Second, remember to review strategies and rebalance. This is to ensure that your portfolio is aligned to your objectives and risk tolerance and takes into account the changes during the year on how certain asset classes have performed. Once a year is usually a good time frame that we tell investors to look at when it comes to rebalancing. Thirdly, you can switch players whenever necessary. So for example, what we've done last year is to actually have China in the core portion of our portfolio. It used to be in the supplementary portion. And the simple reason is that the importance of China as a region, as a market for investors has just been growing over the years. And we believe that it was the right time last year to actually shift China equities into the core portion of our portfolio. Similarly, one change that we did in terms of telling investors how you can look at a core and supplementary portfolio concept was to actually add a segment in the core portfolio for digital economy. And we've done that a few months ago in terms of sharing ideas to with investors on asset allocation. So digital economy, of course, can include a few segments. So some of them can be e-commerce, fintech, digital advertising, cloud services, and so on. The next slide shows the inter-asset allocation, firstly, between broadly the two main asset classes that we look at, which is equities, firstly, and then bonds. So within equities and bonds, depending on, let's say, your risk profile, so if you're looking at the balance profile, for example, so usually a neutral allocation would be about 50% in equities and 50% in bonds. But what you see here is that at the start of this year, our research team was more bullish and has been more bullish on equities. So there's a slightly higher proportion compared to the neutral 50%. So we're at 57.5%, for instance, for the balance part for equities. And correspondingly, of course, then it's 42.5% bonds. So that's one way for you to, look at how you want to allocate your funds between equities and bonds. The other concept here on this slide is, of course, the intra-asset allocation. So what we're talking about here is within equities, what would you like to do? So would you like to have a bit more in US or a bit more in Asia, Japan? And just now I mentioned that, we have also included China and digital economy into the equities core portion as well. And likewise, the intra-asset allocation also applies to the fixed income portion. So within fixed income, do you have more in Singapore-centric bonds, global bonds, Asian high yield, and so on? So this snapshot here on this slide is just to share with you some of the ideas that we hold as a research team in terms of guiding you in terms of, the asset allocations, whether we're overweight or underweight certain sectors. These views change frequently, and you can take a look at our articles on our website and mobile application just to see, whether our views have changed throughout the year. The next concept here that we would like to share with you, and it's something that is close to my heart, is something that I have been doing for a number of years to achieve, some of the goals that I would like, whether it's to build a retirement, portfolio of a decent size for my family, or to grow the educational funds for my children. So RSP strategy is simply, just giving myself and I think for investors, the discipline to achieve your long-term goals. And here there's a quote from Benjamin Graham, the father of value investing: the investor's chief problem and his worst enemy is likely to be himself. So in the end, how your investments behave is much less important than how you behave. So essentially, RSP strategy gives us a discipline to invest once a month. As a fresh graduate back in the year 2003, I found unit trust to be an easy way to get started, with a small sum of money. And what I mean by that is you can start an RSP just from $100 a month into a fund. On this slide as well, I have a screenshot of the Rrsp Calculator. So it's a tool, a simple tool that we have on our website that gives you an idea. If you put in $100 a month or $1,000 a month, and let's say you already have $25,000 in your investment portfolio, how that would grow over different periods of time. So it can be over 5 years, next 10 years, next 15 years, next 20 years. And the next slide kind of visually shows you this on the top left hand side. Depending on the number of the different types of returns, you can see how your investment portfolio could grow over time. The other tool here that we have on our website is the retirement calculator. So that's another tool that you can make use of. It's located in the CPF educational segment of our website that I shared with you just now. So again, if you're looking to achieve a certain lifestyle in terms of the expenses that you would like in future, so you can put these various criteria into this retirement calculator tool just to know how much you need to invest. Of course, like what Jonathan has alluded to just now. So tonight it's really about celebrating the funds that have performed over a long period of time. And the jewel in the investment journey is really the recommended funds report. So in the first edition back in 2001 of the recommended funds report, our research team shortlisted 29 funds for investors. Today's edition that we're sharing exclusively with you, we have 42 inside selected from our research team. So our research analysts have spent time to look into the various metrics in giving you this list. So it spans myriad sectors, quite a number of sectors, but in a sign of rapid changes in the global economy, they've added new sectors in this year's edition, including disruptive innovation and other new sectors such as China Asia's, ASEAN, and global healthcare. The research team also has a methodology in assessing the funds, and you'll find that in the report. So you'll find that, for example, performance is the key factor, of course, but also other factors such as expense ratio, the risk, and in terms of risk, how they look at it is, not during good times only, but also during bad times, during volatile market conditions. How do these funds perform? So they look at all these numbers to come up with their recommendations. And the style matrix that you can see here, and the 3 years returns in terms of maximum drawdown and the risk return ratio. So all this information is available in the report. And we have also been working on making things better in recent times in terms of providing a better user experience for you, our investors. So we've just released our newly revamped Fsm Mobile App on the 18th of July. You'll find that you can make use of various features in your investment journey. So for example, you can filter and view by recommended funds in the app, and you can do a buy or an RSP on the same page. So it is meant to be even more seamless for the new app today for you to build your investment portfolio and to achieve your goals. So tonight we're here to celebrate the funds that have performed and show up in the recommended funds report. But as Jonathan mentioned just now as well, we're here to celebrate the top selling funds across different asset classes, as well as the best risk adjusted funds and the Fund House of the Year award as well. We thank our Fund House partners for the many years of sticking to their investment philosophy despite all the market volatility, and for being really a fun partner for us in terms of how to grow our portfolio over many years. I'll wrap up here. On behalf of the FSM team, the Fund Supermart team, to all our investors, we hope our investment ideas will continue to spark a long-term passion in investing in you, and that we can continue to do what our mission statement states for many more years to come in future, which is to help investors around the world invest globally and profitably. I hope you will enjoy the webinar tonight. Please stay safe and healthy. And on this note, I'll pass the time back to Jonathan. Thank you very much.
Thank you, John Paul. Next up, we have invited 3 Fund House representatives from Nikko Asset Management, Franklin Templeton, and UOB Asset Management, who will be joining in the panel discussion where they will be sharing more on the various aspects of investing in the new normal that we have been thrusted into following the pandemic. Moderating the discussion will be Mr. Sean Tiao, Senior Unit Trust Analyst at iFAST Singapore. Sean is a key member of the team behind the FSM Recommended Funds report. And on the panel tonight, we have Mr. Brian Low, Account Manager for Franklin Templeton Wholesale Distribution, Mr. Darius Fu, Head of Intermediary Business Development, Nikko Asset Management Asia Limited, and Ms. Audrey Cheng, Director, Intermediary Sales from UOB Asset Management, gracing our event this evening. Over to you, Sean.
Thanks for the introduction, John. So, hello everyone, to all of the audience watching this video right now. I'm Sean. I'll be the moderator for today's panel discussion. And as mentioned by John, I'm joined by Darius, Bryant, and Audrey. And first and foremost, I think I would like to thank the three of you for joining me today. So I think without doubt for today, we are here to talk about investing. And I think the best thing about investing for me is that, you can basically talk about anything under the sun, because some way or another in this globalized world that we are in, small problems, if left unchecked, can lead to very big problems for the rest of the world. And of course, all these big problems can have very much leave a lasting impact on our lives. We have seen this many times over and over again. So I think for this year, we have seen COVID-19, we have seen equity markets rise and fall dramatically. So I think just to kick this discussion off, I'm actually interested to hear from our panelists with regards to their portfolios. How have their portfolios performed over the past year? And what strategy has proven to be the best, the most resilient for their investments so far? So maybe Darius, you can just start things off, keep things rolling.
Right. Thank you, Sean, for that question. I guess I have to make a bit of a disclaimer first, especially since right at the beginning I saw John Paul's soccer layout, right, where he has the goalkeeper, the defender, so on and so forth. And I can't help but notice that in his formation, he has Singapore bonds as his goalkeeper, and all the various types of global bonds as his defenders. I want to say that my disclaimer as such is that I am a little bit of a longer term investor and a higher risk kind of a taker. So my entire defense is empty. So what I mean by that is coming into 2020, my entire personal portfolio allocation and all that was into equities itself. So you can imagine that when we hit about the period of March, my portfolio was severely decimated. But fortunately, as Colin has shared also, the recovery was very quick in the 2 months. And I saw my portfolio kind of recover back to almost where it was. But in answering then specifically what held up well and what has done well, I take comfort that there was a certain portion of my equity positioning in what I call defensive offense. So it was still allocated to equities, but about a 40% weightage of that has already been parked into what I call defensive stuff that is either undervalued, so markets that are not very well favored during the turn of 2020. So a good example would be Japanese equities. During that period of time in January, Feb, nobody was buying Japanese equities. I decided to put a little bit of money, thinking that Nintendo, as well as some of the gaming companies have all done well. So fortunately, that has held relatively well because the fallout was not as bad in some of these undervalued and under-noticed stocks and shares. And before I pass on to the rest, the other thing that held out very well, obviously, was the segments of the portfolio where the fund managers were invested in cash-rich companies looking for income. And the real reason was I did personally feel that the markets will correct a little bit. Of course, I didn't have the vision that it would be because of COVID-19. So I was already gearing my positions in my portfolio to be a bit more defensive. So hence taking off global equities, taking off US when they were in the money, and sort of parking them into dividend yielding kind of stocks or funds. And so that has held up well as well because in the fallout, it no doubt also dropped 20 to 30%. But in the immediate run up, they seem to have held out even better and recovered that bit quicker. Obviously, minus the tech sectors and all that, which again, Colin and has mentioned has rebounded phenomenally. So that's what happened in my own portfolio.
Yeah, I guess it kind of makes sense when you think about investing is that, you want to have that margin of safety. And I think that's basically what you had in mind when you invested in Japanese equities. So I think, yeah, that's great. So perhaps we can have Brian to share with us what part of his portfolio has been the most resilient.
Yeah, sure. Thank you, Sean, and good evening, everyone. It's good to be here joining you guys for this evening. There's been a lot of developments in the market. The first half of this year was a very interesting year for all of us personally as well as within the financial markets. So it goes without saying that most asset classes, sold off quite a fair bit as we went into March of this year, and then we saw that rebound coming in with varying degrees. I think what has actually been doing really, really well has been markets that have been led by US equities, as well as a large part of it being led by technology. I think during this period of time, it also brings home the fact that we do need to stay diversified. And I would say that one of the more slightly overlooked asset classes was actually gold. Now, if you look at the price of gold as well as unit trust that is really investing in gold mining companies and gold equities, these are the strategies and funds that have actually held up quite well even till today, when we are still experiencing some sort of volatility in global markets. So I think the fact that gold as an asset class has recovered really well and continues to do quite well, and gold-related equities and unit trusts continue to have that strong backing of gold price, has actually drove home the fact that it is quite important to be diversified. And I think that is one key takeaway that I would share with everyone on this session here today, as we continue to look out into the next half of 2020.
Yeah, I think just to give some context to what I think Brian has said about gold. So I think for the second quarter for this year, we put out like a fund update, and gold actually came up on top. Like out of the 10 best performing funds, we had maybe about 7 to 8 funds being in the mining business or in the gold mining business. So I guess it really pays to have a little bit of money in everything, because you don't know when it will outperform or underperform. So you just want to spread the risk all over. Yeah, so I guess thank you for your input, Brian. So Audrey, can you share with us which part of your portfolio has been the most resilient so far?
Okay, hello Sean, good evening everyone. Yeah. So we had a pretty decent year, in fact. So one of our quality growth strategy did really well. The strategy took advantage of the volatility to upgrade the quality of the portfolio that we held. So we bought into higher quality companies with minimal debt and strong balance sheets that are well positioned for future growth. We also cut our positions in financials in view of low rates and consumer-oriented companies given the current situation. So our process shines through in times when markets fall and the fear is high. So that is when our approach to owning high quality companies with clean balance sheet, with strong free cash flow and high return on capital, and a willingness to return that cash to shareholders has the greatest potential to generate outperformance. So we think this approach also limits the potential for big mistakes, resulting in attractive upside and downside capture. And also, we have constantly been talking about the future is on sale. So technological innovation continue to transform nearly every sector of the economy. Mobile payments and digitization are still rapidly disrupting the financial sector. Aging populations and accelerating drug innovation are persistently expanding healthcare opportunities. So with the market recent volatility, we stick by our investments in many of today's most compelling long-term themes.
All right. So yeah, I mean, I actually do like the fund a lot as well, but it's something that has been on our radar for quite a bit, and it's I believe it's something that's available on CPF, right? Yeah. So investors, if you're interested, I mean, just feel free to go check it out. So again, just to move on to the panel discussion, I think a lot of things were said about the importance of diversification. So my question to the panelists is that what is the biggest lessons that you have learned from the market volatility this year? I mean, aside from the fact that it's important to stay diversified. So perhaps Darius, you can just take this.
Sure. Thanks again, Sean. I guess I'm going to speak general and not specific to any Nicole AM funds per se, or even my own experience. But I think what has been one of the biggest learning lessons for 2020 surely must be what goes up at some point must come down. And I think I say this again with all humility because everyone has always been talking about that 7-year cycle, 8-year cycle, and then we're all late, so on and so forth. And thinking about it now, we're kind of like at the 12-year mark of what was the global financial crisis. And I'm sure all the supposed bears out there has been calling a correction for the last 4 years, only to have not gotten it correct. And even when they sort of gotten it correct in March, it was for a complete different set of reasons. And then again, only to see that completely wiped out. So I do think that, the first thing that we have kind of learned from, 2020, the first half, is that we have to be a little bit more active in our portfolio management. So for the investors out there, it does mean that, kind of the days of, well, I'm just going to put it there, sit and wait for 10 years, wait for 5 years, kind of over. And I really like what John Paul also said about, rebalancing our portfolio at least once a year. Sell what is making money, top up what hasn't, or choose to substitute players, if you like, again, borrowing his analogy. I think the other second thing we kind of learned and about the first half of 2020 is that, the key problem, and this is a little bit protracted since the days of the global financial crisis, is really the issue of debt. And as the saying goes, when we're all swimming, everything is fine and dandy. But when the tide goes out, you see who's, underwater naked, so to speak. And I think this crisis especially has left a lot of companies reeling because they were, struggling with, cash flows, or at least the cash flows was meeting the day-to-day expenses. But the moment we had stoppages and halts and all this others, it really devastated a lot of the company's cash flows. And that's where you see debts mounting, so on and so forth. So if I were to take anything going away from first half, going to the second half, as part of my 2-point sharing, I would really say let's be a little bit more active in the second half of the year. Look for opportunities. Let's not be overly greedy. If the rebound has been good to us, we're up 10%, 20%, so on and so forth, let's look at trimming some of the positions and topping up into some things that are undervalued, or even in your own portfolio, you're losing money, so to speak. It's a good time to just, top up into that. And I think in the course of doing that top up and looking for opportunities, it's always good to go in with your eyes a little bit wide open. So that means that even though you're investing in funds and relying off the research that, Sean and you and Colin and everyone has done, it's also good to know from the personal investor's perspective, what are each of the companies doing? And as a result, ascertain what their business model is like. Are they, cash rich? Are they strong in their financials? Or are they going to be one of the victims going into the second half of 2020 into 2021?
Yeah, so what about you, Brian? What's your biggest lessons that you've learned for the first half of the year?
Yeah, I would first probably share that, and I would think that a lot of people would agree, is that we went into this year without having any precedent, without having any previous playbook, because this was really the first time in our lifetime that we have encountered a global health crisis, which then have led to the state of things that we now are. And I do think that the second half of the year, there will be quite a few lessons in store for us, and I do think that it's also important, like what Darius also advocated, to take a very active approach in really looking at our portfolios and our investments, and try to not stress too much, because when you are invested, when you take a very active approach, you also have to ride along with the ups and downs of the market. Now, if there's one key lesson which I would hopefully share with everyone, is to stay invested. Of course, stay diversified. I think that's number one, and stay invested. Now, I can imagine that for a lot of us and for a lot of our clients that we have been speaking to, panicked when the first drawdown came in starting in February, and it seemed like it couldn't end, and it went all the way too much. And of course, after then, we have seen this quite a very sharp rebound. I would also think that a lot of people panicked and they sold off their investments and they prefer to hold cash. Now, of course, on hindsight, we knew that if we had held on to our investments within a short 3 to 4 months, a lot of those losses have actually been regained. Of course, none of us would have called out or knew that this rebound is going to be so sharp, this rebound is going to be so sustainable. So I think if there's one lesson is to first be diversified, and I think that helps to mitigate and optimize our portfolio. And of course, not to panic when things don't look as well, when things are selling off. And I think one of the better investment strategies would be to just stay invested and go on for the ride. Markets have always proven to end up at a higher place from the previous bottoming down. And I think that has always been the case. And as I look forward into beyond just this year, I think we're pretty optimistic that there will come a day when we will start to see things slowly and gradually move back to normal days. And I think that the approach now is to not stay on the sidelines, take a more active approach, and to slowly find these opportunities as we move along into the rest of the year.
Okay, so staying diversified and staying invested. What about you, Audrey?
I had this conversation with our investment partner that we have been working with for very long, and one thing that they said really resonated with me. I thought I should just summarize it in my own words. Over the last few months, I've been working from home, right? So I start my day at 8 plus in the morning, and then in the blink of an eye, right, I looked up and then it's 12:30 p.m. So more often than not, it's also the time that my husband will ask me the golden question, what's for lunch? And at 12:30 p.m., right, it's a bad timing because by the time you whip up something and clean up the kitchen, I wouldn't have time for my 2 p.m. meeting. I'm the kiasu kind that I need to be ready at my laptop at 1:40 p.m. And if I were to order Grab food, right, I would take half an hour to decide because I'm a girl, I'm a lady, and what to order. And then another half hour for my lunch to be delivered. So every weekday, right, this is a repeat. So where did the time go? So in the short term, right, time seems to be our greatest enemy. Every hour you receive breaking news about the volatility in the market, about the economy, about the number of death cases, about the number of infection cases. But on the other hand, time is our friend. As human beings, right, what we are afraid of today and when tomorrow comes, we look back and then we wonder why we were so afraid to be forward thinking. At some point, each passing day will bring about news of triumph, of solidarity, and commendable acts from our essential workers, our healthcare professionals, our scientists, our global leaders. And lastly, time is on our side. In good times and bad times, right, we can always use time to our advantage. And that is looking at long term, like what Brian has mentioned earlier. I can't stress enough the importance of staying invested. Tomorrow will look better than today, and the market will discover that point earlier than we will as well. So in a nutshell, time is our enemy, time is our friend, but time is on our side. So be patient.
Yeah, so speaking about time, I think the thing about time is that times are changing. So I think a lot of things that we see in the media these days is that, they're labeling, we're moving towards a post-pandemic world, and that will be the new normal. So what are some of the significant changes in terms of business environment, in terms of how we should invest that you see coming in the coming years, of course, and how should investors actually prepare themselves for it? Again, back to you, Darius.
Sure. Thanks for that, Sean. I was just going to say maybe the next few questions we should let Audrey and Brian go first, just to be a bit more fair and that I don't really steal all their answers first and foremost. But I think this is an interesting question. Obviously, what is the new normal? I mean, let me take it from a basic level first and foremost. A lot of us are right now work from home. So the new normal even will be when we all go back to work. How much flexibility will we be accorded? Because from one moment we were 100% in the office, then 100% kind of work from home. Do we swing all the way back, or is the new normal for even work conditions going to become, where we can be some kind of 50-50, 60-40, 70% 30? And I think this is also going to be interesting because why? After this entire, or rather in the midst of this situation, companies are obviously thinking about how to cut costs and all, right? And one of the obvious ways is if you give people this situation where they are now 100% work from home, it does obviously mean if some kind of new normal kicks in and you can accord and survive with 50-70% of people in the office, does that mean you can save on rental, you can save on expenses, so on and so forth? So this will be a very simple example in terms of how companies will catalyst change within themselves. And so, I mean, for the investors out there, I guess in whatever fund or in whatever choice that you're making, you're going to start to have to really understand and analyze, for example, which sectors are a little bit more proactive in terms of going work from home, where are some of the cost savings and so on and so forth. This might also cause us to rethink on the impact of, for example, REITs. Can REITs continue to earn the kind of earnings that they do? So I do think that when we say this new normal, there's a lot of knock-on effects. So right from the granular level of expenses. The other aspect that I think I wanted to kind of focus everyone on is that while we were all suddenly thrust into this, and obviously one of the key winners of this entire situation is Zoom itself, right? The platform that we're using now. Before COVID-19, can I just be very honest, I didn't have a Zoom account. And I'm sure many of the 210 people on this call didn't as well. But what we were all very happy with is just maybe FaceTime or WhatsApp video. But suddenly we all got thrust into this new normal, which also means from a user experience, there are more things for us to latch on, to learn, and therefore acquire new skills. And that is something I think even at the company level, at the businesses level, they have to do that as well. And from that environment, that again changes the way how companies behave. So last but not least, I talked about expenses, I talked about skills, it's really also revenue generation. So in this low for longer, which everyone has been talking about, every cent of revenue will start to count as people want to grow their companies and all. And interestingly, I'm not promoting for them, but I just heard this on the news last night. So I'm just going to use them as an example. We all may have heard of this company called Audio House before in Singapore. They have an online shop, they sell earphones, TV, so on and so forth. But they were interviewing their senior management team and they said, look, just to survive during this period, we have an online platform that's very usable. We're now partnering with smaller businesses to sell rice, to sell groceries and all these other things, and fulfillment and all that. They've worked everything out at the back end. And I just think that this is something that a lot of people will now have to start to consider when you're looking at your portfolio of investments, companies to companies. Where is there more synergies? Where is there more collaboration? And when you start to have a fuller picture of all these, then you can really see is there going to be long-term sustainable gains that can be gotten for these companies and in return for your investment portfolios. Yeah, so this is my 2 cents worth.
Yeah, all right. So I guess the next time around, let's have Audrey to actually have her answer the question, because Darius called me out. I'm sorry. I should have been a gentleman. So Audrey, please share with us how can investors prepare for themselves?
Okay, thanks for this chance. Okay. In this new normal, we expect to see the wheels of globalization spin in reverse with more siloed economic blocks. So in such a deglobalized world, right, we will expect to see a manufacturing renaissance in the developed markets and more localized supply chains as well. So for example, for goods in critical sectors such as drugs, medical supplies, and food, right, your local self-sufficiency would be highly valued over global efficiency. And then your regional supply chains would then form with a dismantling of the giant global supply chain as well. So this supply chain makeover will be supportive of circular investment themes such as automation and digitization. These new manufacturing setups will likely be highly automated by robots rather than being heavily reliant on human power. So this would mean more investments in robotics, in automated factories, industrial software, and high-tech warehouses. Secondly, the more immediate concerns of government now, right, is to save lives and jobs with the massive costs involved. So this will likely push climate change initiatives to the back burner as well. So the stresses brought on by social distancing, huge job losses, and premature loss of lives, right, and with trillions of dollars spent on fiscal stimulus, will leave very little political energy and money to address global warming. But over the long term, we expect a push for sustainable investing and a focus on ESG, right, to remain at the forefront of investment management. So in fact, COVID-19, right, we could see a reshuffling of decks as individual companies' behavior towards society in this crisis will be remembered, with businesses deemed to have done the right thing by their employees, by their customers and communities, right, will then be favored as well.
Right. So even though we're moving towards a world where things could change, but long-term problems like climate change is not going to go away. So I guess it's still important to focus on issues like ESG, because it's definitely something that's going to be with us for a long time, in my opinion, of course. Yeah. So Brian, share with us some what you think, how you think investors can prepare themselves.
Yeah, most certainly. I like to think of the kind of changes that have been brought into our lives ever since in the last 4 to 5 months of the year, as a lot of us had to first started to work from home, and before we knew it, we did everything from home. So we are really, in some cases, been forced to adapt into more digital ways. And whilst this looks to be we don't still know if this is a temporary normal or this is going to be a permanent normal. But I really just want to share with you how we think that some of this, what I like to call digital habits that we have adopted, may actually last even as we move towards a more gradual reopening and as things hopefully start to get back to normal, right? So maybe just a couple of examples that I think some of us may actually be engaged in right now. Working from home is the norm. In many parts of the world, we are still looking, schools have still been not yet open, schools are still shut, and children, school-going children are still being educated from home. And I've been speaking to some of my colleagues from the United States, where we are based. He's telling me that a lot of this studying from home, educating from home actually works for his children. And even if schools reopen, he may not actually want to send them back because it works. His children gets a couple more hours of sleep and he saves that time from commuting back and forth from school. Another example would be exercising from home. Now, a lot of us like to keep fit and healthy, and I hope everyone is doing a good job at doing that. At the same time, we might not be so comfortable congregating with a lot of other people, even when gyms are open. So there have been a lot of mobile exercise from home companies that have just capturing a huge market lead. Okay, and the way these companies engage their subscribers to their online exercise classes, for example, brings in a whole new level of innovation as well as a transformation of the entire experience. And as from what I know, all these subscription services definitely are much more affordable than a gym membership. Another good example is what I think we should all be quite familiar with the term telemedicine. Basically, we are able to consult with our nearest GP using virtual methods, for example, via a Zoom call, rather than actually heading down, especially when we're not feeling well, right, to our nearest GP to get ourselves checked out. And I can tell you this is a theme that is probably going to gain traction because for a lot of us who may not be feeling under the weather or who are feeling under the weather, if we can get our consultation done via virtually and get our prescriptions delivered to our doorstep once that consultation is over, I'm pretty sure that even when things get back to normal, these sort of behaviors would probably stay. So this is just a very quick, case studies of a few examples that we have been doing from home or in for what some people would say forced to adapt during this period of time that might have the potential to last for us in the next few years to come. And I think that when it comes to investments, when it comes to taking that active approach, I also would like to echo what Darius also mentioned, to really look out those strategies that is really taking that sort of active approach, adapting to this hope, maybe new permanent normal that we might be expecting in the future. And I think that that is a good position and good strategy that a lot of investors should consider, especially when they're looking forward for their portfolios over the longer term.
I think what you shared is actually quite interesting because forward-looking means you need to have an idea of how the future would be. But I think when you look at passive investing, right, investing in ETF, it's not necessarily forward-looking because you're not going to have your Zoom, you're not going to have your Tesla, for example, within the passive index. So you're not going to have all these emerging or I would say forward-looking ideas, and I guess that really is where active funds really do have an edge. Yeah, so I guess actually we are running out of time. So I just want like perhaps each of you to give like perhaps a 30-second key takeaway message that you would like investors to have. So Audrey, would you like to start the ball rolling?
Yep. Circling back to what I said earlier, time for patience, time for survivors. And I think actually Darius mentioned this earlier, borrowing a phrase from Warren Buffett, right? Only when the tide goes out do you discover who's been swimming naked. Yeah.
Okay, Brian?
Sure. Thank you so much for having us for this session. It's been a great pleasure to be having this discussion with you. Maybe a quick takeaway. Also, really thinking back on what I've been able to share with everyone here would be to stay invested. One thing which we are anticipating is further volatility ahead. When that happens, two things: do stay invested, don't panic, and as well as try to take a more active approach in looking out for areas of diversification. One area that you might be able to consider, and it's something that is quite accessible for all of us, would be probably allocation to gold if you don't have it in your portfolio. So stay invested and do please be diversified.
Darius, take us away.
Well, for me, again, I'm a little bit more of a risk taker, despite I think I'm the oldest person on this panel right now. But really, I still feel that there's a lot more opportunities in the equity market, say what you like. Take away all the hype in the tech space and all that. So do hunt for value right now, because again, I'm sure many of the investors listening in, you're not invested just for today, tomorrow, next year. It's a long haul, and there are a lot of things that can be gotten at good valuations at this point in time. And more importantly also, like what you says, I think as we go into this new normal, try to imagine a little bit. And I think Brian said a little bit about even working from home. There are things that we can do now with the saving in commute, for example. And just to give one final example, because as we entered into this tech era, a lot of people were talking about how Facebook and all that will make money because people will be watching ads and all these other things via Facebook and all. But you think about it, now that we're not commuting, where has some of that revenue and all that gone to? It's gone to e-gaming, for example, right? Everyone now, I can knock off at 5:30, and instead of traveling for 1 hour, I play Dota for 1 hour. So this is a new avenue of where expenditure is got to go. And I think that's just where I want to leave off that. This has been a rather shock to the system, but feel free to imagine what the new world is going to be like. And when you imagine what the new world is going to be like, ask yourself, which are all the companies that are making that happen? And that's where you will see value in the investment world today for the next 3 years, 5 years, and onwards. Yeah.
Yep. All right. Thank you, Darius. Yes, I wish we had more time for this conversation. It's been quite interesting for me so far. But I think we have to move on to the next segment. So, John, can you show us what's the next segment going to be?
Right. Thank you, Sean. And thank you to all panelists for such an insightful sharing.